All right, class, what we're going to do on this video here is I am going to go ahead and go over the example problem with you that is listed on chapter 3. And so I want you to just go ahead and open up the adjusting and closing entry example problem that you see there. And that will bring you to the Word document that I want you to follow along. Now, as I've said to you in your first video, the adjusting entries are something that is very important for you to pay attention to, because for those of you that are accounting majors, you're going to have to be doing them later on in life. For those of you that aren't, I hate to say this and don't ever repeat this, is that, it's something that you need to know for this course. And hopefully we can get through it pretty quickly and easily so that we don't have any problems. Now, I also told you that on your exam, the adjusting entries problem is going to be very similar to the questions that you have been given or that we have done as homework assignments. So right after this video, you're going to have the homework assignment that's going to be posted that is going to give you something to do. It's going to be a couple adjusting entry questions, things like that, and it will have a closing entry question, 2 closing entry questions also. So this video is going to go over the adjusting and closing entry example problems that you see in front of you. Now keep in mind, the keys to adjusting entries is paying attention to the slide in chapter 3. You always want to pay attention to, depending on the situation, look for keywords, okay, or look for the accounts. We went over the 4 different types. So like right off the top of my head, type 1 journal entry was a expense account going up and a asset account going down. When you're talking about a type 1, you're talking about things that have been used up or has been expired. So I'm going to try to go along these and get you guys set up as best as I possibly can. So if you take a look at number 1, it says office supplies had a balance of $336 at the beginning of the year, which is January 1st. Purchases made throughout the year total $1,660. A year-end inventory account, meaning at the end of the year, they made sure they took a look and saw how much they had left, reveals that there's $1,140 worth of supplies that were remaining. So your first thing you need to do is 2 things. Number 1, you can tell what your asset account that you're using here is. It's supplies. So your asset is going to be going down, supplies is going to be going down, and then you're expensing something, so you're going to use supplies expense, which is going to be your debit. Okay? So now that you know your account that you're going to be working with, now you have to figure out the question, how much has been used? And the easiest way is just draw yourself a little T chart. And what I want you to do is just grab a scrap sheet of paper and pen and have a little T chart with you. At the beginning, at the top, write supplies. Now, if your balance is $336 in your supplies account, you should be saying to yourself, well, supplies is an asset, which means it has a normal debit balance. So that beginning balance, 336, would be on the left-hand side, which is your debit side. So go ahead and write your 336 on your debit side. Now, if you added supplies to it, which is what you do by purchasing, that would be an add, or your supplies would be going up. So that means you're going to have to go ahead and you're going to debit supplies for the amount that that's talking about. So then you're going to have 336 plus 1,660. So that's your debit balance in your supplies account. Now, at the end of the year, it says you only have 1,140 left. But your supplies account says you have, what, 1,996? So how do you go about figuring out how much you have used up? Now, if you supposedly have 1,996, but you actually only have 1,140, the difference is how much you used up. So if you went ahead and you subtracted those 2 numbers, you can see a little bit further down under 1A, you'll see that I have a debit to supplies expense and a credit to supplies. And the amount is for $856. That's all it is. That's all it is to a journal entry, adjusting entry. That's it. Number 2 is the easiest adjusting entry of them all. I gave you guys the acronym DEADASS. DE, which stands for depreciation expense, and then the AD stands for accumulated depreciation, and then you're just going to put a dash and then whatever the asset's name is. So in this case, number 2 says depreciation of office equipment. So there is your asset name, is estimated to be $2,130 for the entire year. So again, use your dead ass example. Okay, dead ass depreciation expense for $2,130, accumulated depreciation dash equipment for $2,130 is your credit. That's all there is to that entry. It's a very easy entry. Okay. Now, with that being said, now we're moving on to number 3. Property taxes for 6 months estimated at $1,800 have accrued, but had not been recorded. Okay. So this is the one where I forget what type it is off the top of my head, but you're going to go ahead and you're going to debit property tax expense and then property tax payable. So this is showing that an expense is going up and a liability is going up, meaning you owe somebody something. Okay? The biggest thing I want you guys to pay attention to when it comes to these journal entries is being able to read the narrative of the question. And if I was you guys, I would have like a scrap sheet of paper of a little bit of important notes when I'm taking my exam. And I would have things like type 1, type 2, type 3, type 4, and just read it. Property tax accrued. Well, but have not been recorded. Just you got to say to yourself, that's a payable and that's an expense. Number 4, unrecorded interest receivable. Well, receivable right there, whether it's interest receivable or accounts receivable, is an asset. Okay? So that's one thing right there, is something that's a receivable is going to be an asset. On U.S. bonds, so it hasn't been recorded. So that's money that's owed to you that hasn't been recorded, is $850. So your interest receivable is going up by $850. And the other thing here is that a company can have multiple different types of revenues. In this case, the revenue that we're talking about here is what we call interest revenue. And any revenue account goes up with hopefully you're saying to yourself, revenue accounts go up with a credit. Hence the reason why we're giving it a credit. Interest revenue is credited for $850. Number 5, unearned revenue. Well, unearned revenue, you should know now, is a liability. And it says it has a balance of $1,800, meaning it has a credit balance of $1,800 because liabilities have a normal credit balance again. Services of $750 received in advance have now been performed. So what that means is you've done $750 worth of work out of the $1,800 you owe somebody. So now what you need to do is you need to record the $750 that you've now earned. So you have to show your liability going down, which you show your liability going down with a debit. So you're going to debit unearned revenue. And then now you've done work. So now you've actually earned the revenue. So you have to increase your revenue account, and you increase your revenue account with a credit. So as you can see down under 5A, we're lowering the liability account with a debit to $750 of $750. And then we are crediting, which is increasing our revenue account for $750. The last one, number 6, services totaled $800 have been performed. The customer has not been billed yet. So if the customer hasn't been billed yet, there's no way that you've been paid yet. So that means somebody owes you something. They owe you that $800. So what account tells you that somebody owes you? Not that you owe them, but they owe you. And the fact that somebody owes you money is what we call accounts receivable. So accounts receivable is an asset which goes up with a debit. So you can see the debit to $800. And then why does somebody owe you money? Because you did work for them. Obviously, you see here it says services, $800 performed. So that's your revenue account. And we show revenue going up with a credit. So you can go ahead and credit revenue for the $800 that has now been performed. Okay? One thing I want to make mention about when it comes to adjusting entries, your question on your exam is going to look exactly like what you see here in front of you. it will be very similar. The numbers will change. Maybe the account, like instead of office supplies, maybe it'll say, I don't know, prepaid insurance or something like that. But for the most part, your adjusting entries question is going to look exactly like what you see here in front of you. So please make sure that you study the adjusting entry questions very closely, because they're going to look just like this. So I'm going to break this video up into two. So that's going to be the adjusting entries part.